Welcome, everyone. I think this is week 4 of our current event. So, for those of you who've been here all the way, thanks for sticking around. I'll do a bit of housekeeping for those who haven't attended in a moment. I don't think it, it we would hold anything against investors in the last couple of years who've taken a fresh look at corporate and government bonds. But 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 with the interest rates that have led to that renewed interest in those asset classes, obviously comes higher inflation, or in fact, it's the other way around, isn't it? And so I think there's really no better time now, with inflation somewhat abating, to take a fresh look at some asset classes that offer pretty predictable real returns that have been somewhat undervalued by the stock market as a result of that rotation into fixed interest. And so I'm really pleased we've got the CEO of one of the leading infrastructure trusts on the London Stock Exchange, and indeed a FTSE 250 company, Duncan Ball, who runs a trust that is really at the very predictable end of infrastructure real returns. He's going to talk you through the landscape as he sees it, and some information about the trust, and then at the end there'll be an opportunity for Q&A. And as I said, for those who haven't attended before, I think probably most people have. It's pretty straightforward. There's a Q&A box that you can type questions in. I'll be able to see those, and Duncan and I will have time for a discussion at the end. But I'll stop talking now and hand over to Duncan.
Thanks very much, Alan. Pleasure to be here, and thanks for hosting and inviting us to participate. And I'll walk you through some slides, and then looking forward to the Q&A and the discussion that'll ensue at the end. So thanks again for having us. Just the obligatory disclaimer that I think every presentation has. It's just saying this is not financial advice, and that the information I'm talking about is going to be based on our mid-year results. We're about to release our year-end results shortly, but those aren't out yet, so I'm basing everything on our June 30th numbers. So just very quickly about BBGI, our purpose is to deliver social infrastructure for healthier, safer, and connected societies. So that's our mission statement. Really what we do is we deliver low-risk assets that are contracted with the government counterparties. These are schools, hospitals, roadways, transit projects, affordable housing. The common theme is they're all availability based, and we're getting paid by creditworthy governments. So just to talk about the 4 pillars of our business very quickly, it's founded on 4 pillars: low risk, internally managed, globally diversified, and a strong approach to ESG. So in terms of the low risk pillar, it's all about we're 100% availability style. Our revenues are coming from public sector counterparties, so very creditworthy counterparties. These are contracted revenues that give us very strong predictability and visibility of the cash flows over a long period of time, and there's very good inflation linkage with these cash flows. The second aspect of our investment proposition is we're internally managed. So we're the only infrastructure company listed on the FTSE 250 that has an in-house management team focused on this. So that means there's no external manager, and I think it results in better governance, we believe, and it also means we're not interested in just growth in AUM. We're interested in portfolio performance and NAV growth and dividend growth. The third pillar is the globally diversified nature of our business. We're focused on AA and AAA rated countries, so we're operating in well-established environments with very credible governments who have a well-observed rule of law. And then the final leg to our table is a strong approach towards ESG. It's very much integrated into our business model. We're an Article 8 firm under the SFDR, the Sustainable Finance Disclosure Regulations. So that means we're a product that has a social benefit to it. If we go to the next slide, this slide just touches on some of the highlights. And as I say, I'll caveat my remarks here by saying these are based on our results at mid-year. These will be updated shortly, but the one figure that is fairly live is our current dividend yield. I thought given the price that we're trading at, that would be relevant. So this was today we're at a 6.6 dividend yield as well. So the net asset value per share is 147.8. We have a predictable dividend for next year and the following year. We're increasing its targeting to increase it 6% this year to 8.4p, and then further growth next year. And based on current share price, we're trading at a 6.6% dividend yield. And that's with high quality inflation linkage of 0.6%, well covered, cash covered dividend yield. At mid-year, it was a little higher than it typically is at year end. Mid-year, we were just a tad under 1.7 times. We said at mid-year that we expected to be at 1.3 to 1.4 at year end. It's just there's certain seasonalities to our cash flows that our coverage ratio tends to be a little higher at mid-year and then settles down to a slightly lower number at year end. And we have very low ongoing charge, and our NAV per share growth since IPO. This is the dividend and the growth in the NAV has been 8.8% per annum over that time period. If we go to the next slide, apologies here. This just talks a little bit about our operating model, and our operating model is really focused on three key themes as well. It's value-driven asset management. It's a prudent approach to financial management, and it's a very selective acquisition strategy. So in terms of the value-driven asset management, we're very proud to report that of our 56 assets, they're all performing well. There's no lockups or blocks on distributions, so everything's performing as expected, and we've operated in that manner for quite some time. So we're very proud of the high availability rate that comes out of our portfolio. Regarding the second principle, the prudent financial management, we have structured our affairs very conservatively. So all of our assets are financed on a non-recourse basis. 55 of our 56 assets have no refinancing risk. One asset has a tranche of debt where the underlying base rate has been hedged, but we have a refinancing obligation every 5 to 7 years. But so that's it. So it's a very, very modest portion of our portfolio. We have assets in different jurisdictions. So we have a robust foreign exchange hedging program that limits our NAV movement on foreign exchange. So that's been put in place. And we have a very clean balance sheet. We reported at mid-year that we had a net debt position of 7.9 million sterling. And we said that we aspire to pay that off by year end. So when we update our results later this month, we will give an update on that figure. But you can see that it's historically been very conservative. And then the final aspect of our operating model is we've been very disciplined in our acquisition strategy. So we're not, again, reiterating the theme, we're not motivated on growth in AUM. We've used our revolving credit facility with some discipline, and that's allowed us to be very selective in what we've pursued. And of course, that applies in the future. Any new opportunities would have to be evaluated and have to be value accretive for our investors. If I go on to the next slide, this just talks a little bit about the predictable and growing dividends and NAV growth since IPO. So you can see in the top chart that we've grown our dividends every year since 2013. The AIC came out this week, and we're very proud to learn that we were included in the upcoming Dividend Heroes. So those are companies that have increased their dividend every year for at least 10 years, but less than 20. And given we IPO'd in 2011, we're not yet at the Dividend Hero category, but we're an upcoming Dividend Hero, having distributed growing dividends for at least 10 years. So we last year in 2023, we said we would grow the dividend 6%. This year, we're saying we will grow it again 6%. And then for 2025, where the impact of inflation is a little unknown, we're saying we'll grow that at 2% until we see where inflation settles out. And you can see that since IPO in 2011, we've been able to grow the dividend on a progressive basis, and our dividend growth has outpaced UK CPI over that period of time. I'm just going to flip to the next slide. This slide shows us not only is the dividend grown, but we've been able to grow the NAV over the same time. So you're getting it in terms of both dividend growth and NAV growth. So we're very, very proud of the fact that we've been able to provide a total NAV return since IPO of about 164% or 8.8% on an annualized basis. Just going to tell you a little bit about our portfolio. So we have 56 assets in a variety of countries. So we're in Australia, Canada, the US, UK, Germany, Netherlands, and Norway. So we're in very strong creditworthy countries, typically AA and AAA rated. Our largest concentration is Canada at 35%, UK at 33%, so we're well diversified. 100% of our assets are availability style assets, so that means if the asset is available, we get paid. So we're not taking demand risk or regulatory risk. These are contractual arrangements where, provided the asset's available, we get paid. So for instance, during COVID, some of our schools were closed, but they were available. And so as a result, we still got paid. Our hospitals were very busy during COVID, on the other hand, and in comparison to the schools, we still got paid. So it's a very much an all-weather portfolio that we have. And that ties into the next box, which is 100% of our assets are operational. We had one asset that was under construction that became available in September of last year, and we reported that. And in terms of our sector split, we're in healthcare, blue light, which is fire station and police stations. We have at schools, we have affordable housing. We have one clean energy project where it's a hydroelectric facility, but it's an availability payment where we're paid if the asset's available. And of course, we have transports. We have a lot of roads. We like roads because these are not toll roads typically. These are roads that there may be a toll on them, but the toll is collected and we're paid by governments, and we're not taking the demand risk. So it's very predictable revenue. This is a slide that tries to address the high quality inflation linkage within our portfolio. So the key message there is that it is contracted and mechanical, and consequently, that's why we describe this high quality. So what that means is we're not subject to elasticity of demand. We're not subject to regulatory review. The statistics come out in the various regions where we have inflation linkage on our contracts, and it's typically RPI or CPI, and or the equivalent in the various countries we're in. And when those statistics get published, we mark up the invoice, send it to the government counterparty, and we get paid. So it's very mechanical, and it's not subject to market risk or regulatory risk. So hence we call it very high quality inflation with a high degree of predictability. We very much pride ourselves on being a responsible investor in social infrastructure. This has really emerged over time. The journey in essence really began in about 2015 when we started to put a bigger focus on ESG, and it's evolved quite a bit over that time period. Um, we put out a standalone ESG report. As mentioned earlier, we're an Article 8 firm, so we're delivering on socially beneficial metrics. We put out our upcoming annual ESG report will come out in June, but anyone who's interested, I encourage you to go on our website. There's a lot of disclosure there. Some of the things that we're doing is we've looked at all of our assets against climate warming and looked at that under 3 different scenarios, 3 different time horizons, under 8 different climate perils. So that's given us confidence that our portfolio is very low risk in terms of being exposed to risk from climate change. So we're not worried about stranded assets. We work very closely with our public sector counterparties and we're developing net zero plans at our assets. So again, that helps deliver good outcomes for society and for the environment, but it also helps us with our clients because they see us as good stewards of these assets, and that's gone a long way towards improving our client satisfaction and the high availability rates that we're achieving in the assets. Valuation is obviously a key concern right now. We use a discounted cash flow basis to come up with our value across our portfolio. And at mid-year, we were using a 7.2% discount rate. So that is based on observed transactions. There still are some assets trading in the sector that give us confidence in that number, but we also use a capital asset pricing model. And what we're seeing right now is a disconnect between how the public markets are valuing these assets and how they're being valued by private buyers, whether it's pension funds or other infrastructure funds that are active in the sector. I'll just talk very quickly about internal management. The key message here is that we think this is a good governance model. It means that the management team is interested in the exact same things that investors are interested in, which is NAV growth and dividend growth. We're not interested in a larger portfolio. We're interested in a high quality portfolio that performs well. So it also means that we're working for the company. We wake up every day. This is all we do. We don't have competing mandates. We're not advising other parties. And so it means we're very focused on the portfolio and there's no conflicts of interest. We're aligned with shareholders in this regard. And the pipeline is obviously a question that we get asked about, and we have a robust pipeline. But in particular in this market, we will have a strict approach to capital allocation. We'll only consider opportunities if they make sense from a portfolio construction perspective and they're value accretive. We have a strategic partnership in North America with an engineering construction firm. We've sourced some assets from that. We have informal relationships with a number of parties in the space who actively develop and then often sell these assets. So we're very much in this center of the information flow for this particular sector. But as I say, we will be very disciplined in our approach. And then, just to bring it all together here, I wanted to talk about how we relate currently in the market. As everyone knows, there's been quite a large sell-off, not only in BBGI shares, but alternative investments in general. And, as we approach ISA season, I wanted to leave participants with this thought. This is some recent research that's come out of the AIC. And Nick Brighton, the head of research there, has published this report earlier in the month. And it really shows that when you invest in income trusts that are trading at large discounts over the next 5 years, there's been a strong correlation with outperformance if you're buying shares at significant discounts. So I think they looked at 128 5-year intervals using Morningstar data, and they found that when you buy trusts that are trading at discounts of greater than 10%, you've typically seen an 89.3% return in the following 5 years. So that equates to about 13.6% annually. So I will very much caveat my remarks here and say that past performance and this study isn't any indication of future returns. But I think it's very much an interesting time to look at BBGI and others in this space or other alternatives, because I think certainly in the case of BBGI, I very much believe we have a high quality portfolio that's currently on sale. So that's the conclusion. So thank you, Alan, for allowing me this opportunity to present to your audience, and happy to discuss any questions or concerns you may have.
Thanks, Duncan. I'm going to test my general knowledge now by asking you, do you have, this is a question from the audience, do you have any exposure to, let's get this right, reinforced, autoclaved, aerated concrete? I think that's what RAAC stands for. You know that there was a
Yeah. So
series of stories about that, weren't there? And you mentioned schools, and do you have any exposure to that, and what are the consequences of that, if you do?
the quick answer is no. The longer answer is we released our results, I think, at end of August last year. And the day we released the results, there was a BBC article on the rack concrete, and there was an article in the Guardian. So I think every investor meeting I went to for the next 2 weeks, well, that was very topical. What we did do, though, is well before it became an issue, back in 2017, we did a full inventory on our portfolio to see if we had any of that, and we didn't. So the outcome is that we don't have it. But I wanted to use the occasion to just sort of highlight the active asset management. That came out last year in the news, but we had done the analysis on our portfolio well in advance in 2017, 2018. We've done the same thing with fire stopping. We had one building that had cladding, external cladding, a building in Australia. And we addressed that very early on, and we changed it. And then the unfortunate tragedy at Grenfell, where again, cladding became very topical. And we were asked at that point in time, do you have any cladding? And we said, well, we did, but we've changed it out. So we do take an active view on asset management. We try to identify these problems early. That's part of the reason why we've done all this analysis on climate change, is to try to figure out if there's any issues that need to be addressed in advance of them becoming more topical.
And without getting too far into specifics, if an issue does arise, is there a kind of chain of other people that you can go to? Do you have warranties over things, and you're not 100% exposed necessarily to issues with assets that you control?
I think, a couple of remarks there. One is we've got a fairly young portfolio. A lot of our buildings have been built in the last 10 years. So they've been built to very high standards, and they've been built to energy efficiency standards, because these are being delivered for government. So there's usually built to very much to the current codes and at the time, and high standards. And they're typically built by tier one contractors. Depending on the jurisdiction, there's this concept of a latent defect. So you get a warranty post-construction that varies from 1 to 2 years. But then if something's not visible, but manifests itself later on, the contractor's obligated to come back, and that period of time can vary between 10 to 12 years. So there is a point at which the contractor's no longer on the hook, but we typically pass down the day-to-day management to very creditworthy counterparties that do the maintenance on the buildings. Some buildings and assets, we maintain long-term life cycle risks, but we have very well-developed models and budgets for those items. So it hasn't been an issue for us. that
What?
address your question?
Yeah, yeah. I'd like to come back to a couple of examples of projects in a bit, but there's quite I think this is quite a fundamental question. It'd be good to clear up from the audience, which is, can you just explain what 0.6% inflation linkage actually means, and what proportion of your revenues are inflation linked, and are there caps and collars or any other kind of terms that might lead those to be
Okay.
renegotiated?
So great question. In terms of, we have 56 assets around the world, so each one is slightly different in terms of what the project agreement says, but the general concept is on every one of our projects, there is some form of inflation compensation. Because you can imagine you're not going to maintain a building for 25 years or a roadway for 30 years without having some kind of protection against increasing costs. So each project comes up with or jurisdiction comes up with an inflation factor. In the UK, it's RPI, typically on our contracts, but in other jurisdictions, it might be the CPI or the equivalent. For some of our roads, it might also include other indexes, but we're getting those increases. There are no caps and collars. It is what it is. It's very mechanical. It happens on the UK projects typically annually. In other jurisdictions, sometimes it's quarterly, monthly, or semi-annually. It depends on what is in the contract. And when those statistics get published, you mark it up. Um, we're protected against increases in our supply chain because whatever we get from the government, we pass down to the operator. So if we have someone operating our buildings for us, for instance, we have some correctional facilities. Honeywell operates those, and with Cushman and Wakefield, we have a whole variety of um, credible counterparties doing that work, and they get passed down that inflation compensation as well. So it's not a case where your revenues are going up, but your costs are going up more. So we're protected against that. And then, as I say, it's at least annually, and it's not subject to negotiation. So it's not you've got to go apply for it. It's mechanical. It's automatic.
Mm. And just to make sure that we get a clear, a specific answer for our viewer, what actually does
Oh,
0.6%
sorry. Yeah,
mean?
I apologize. I kind of
That's right.
lost track there. So the not 0.6, what that means is that if inflation in all regions was 100 basis points higher than our expectation, so 1% higher, you would get 0.6% return higher. So it's not 1 to 1. It's 0.6, it's almost half to 1. So if inflation outpaced our assumptions by 100 basis points by 1%, you would get a 50 basis point increase in your return.
Yeah, it's somewhat analogous to beta on the market.
Yeah, so it's the way we look at it is in an inflationary environment. If you buy gilts, you have no inflation protection. What you're getting with BBGI is a 6.6% dividend yield with about half to 1 inflation correlation. So you're protected against better protected against inflation than you would be with by buying a bond.
Yeah, yeah. You've said to me before, Duncan, I think that you could continue to increase your dividend for 15 years if you never bought another asset. But there's some questions about buying other assets here, and obviously on a discount, raising capital is on hold. But there's a long future for BBGI. So, do you see any kind of opportunities with other infrastructure funds that maybe are higher up the risk spectrum, where there might be some selling that there's a price, there's a risk rewards that might be interesting to BBGI. And more generally, as you mentioned, you've been listed for quite some time now. Do you see a kind of evolution in what infrastructure means? So do you anticipate how do you anticipate the company's portfolio evolving if it became a reflection of what infrastructure will be in 5 years? Obviously the European economy and the US economy are electrifying, and so there's other parts of infrastructure that maybe weren't so prominent when you launched. How do you see that all playing out?
Okay, well, there's a couple questions packed in there, so I'll try to get to each one of them. One of them is about growth, and these are concession investments. So at the end of the concession period, we these assets revert back to government. So the average life of our concessions is around 20, just under a tad under 20. So we often get the question, well, what happens at the end, and what happens if you're not able to grow in the near term? And I think that alludes to your point earlier, where we could do nothing and still pay a progressive dividend for the next 15 years based on our current portfolio. Certainly, our aspiration is not to sit here and do nothing for 15 years, but it means that we're not we're not frenetic that we wake up every morning having to buy assets to continually replenish the portfolio. A great example of that would be we bought two assets in 2022. We bought the A7 in Germany, which is a roadway, and we bought a John Hart generating station in British Columbia, Canada. And we used our corporate revolver for that. So it's over 60 million pounds of investments. And we had expected that we would wait and get a little bit more and then come to the market, raise equity and pay down our revolver. But the markets closed, and what we said at mid-year was that we would pay off our revolver by year end. And so when we release our results later this month, people can see whether we've done that. But it kind of demonstrates the ability to grow the portfolio organically without having to do a capital raise. Just the excess cover, we reinvested that in two assets, and have substantially paid that off by mid-year, and are aspiring to pay it off by year end. So that gives you the concept that you don't have to do anything right now, and the portfolio will still regenerate over time. But in the current market, capital allocation is a key consideration, and it's sort of what's the highest and best use of your capital, and is it to buy new projects, or is it to buy back your shares? And as I said, at mid-year, our direction of travel was, we said first and foremost we would pay down our debt, and then once that's done, we would look at what the best use of capital is. We've been actively participating in the market, trying to see if there's deals. And there are some interesting things out there, but we've gone from a fairly frothy market a couple of years ago to more of I would say, a balanced market. And it's not yet a buyer's market, because the reality is a lot of the assets we buy, they're still performing well. People may have other issues elsewhere in their business that's forcing them to sell these things, but generally speaking, the assets that we kind of focus on tend to do well in all weather. So it's not that there's a situation where you're seeing distressed sales right now. So we haven't seen tremendous opportunities to deploy capital and really attractive returns, but we're still looking, and we're being very disciplined, and we've grown the portfolio in a disciplined manner over the period since we've IPO'd. And then the final bit of your question was just what the key themes are. And I think certainly in the UK, there's been a lot of focus on PFI is dead. What does that mean for your business? The reality is what the business we're in is providing critical infrastructure for society, and usually with government as a counterparty. The reality is, across the globe, certainly the countries we're focused on, governments' balance sheets are stressed. There's a need for private capital to invest and manage these assets. So we're seeing a lot of opportunities. Maybe the nomenclature is changed. They're not being called PFIs or PPPs, but mutual investment models or nonprofit distribution models. But the theme is the same. We're getting paid by governments, and I think it will be, digitalization is a big theme, decarbonization and deglobalization, and investing in critical infrastructure, because it's so important to society to continue to invest, to the nuts and bolts of daily activity is fundamentally entrenched in infrastructure. So
Yeah, thanks, Duncan, and yeah, thanks for putting up with me rolling three questions into one there. There's an interesting question here, and I think could be a good opportunity to kind of clear up a potential misconception. So I'll ask the question, and you'll know why I think it's a misconception, but I think it's worth answering it because of that. So could you please provide an indication of your revenue margin, cash flow visibility over the next few years, and the profile of your contract renewal cycle?
well, so our revenues, I don't have the slide here, but our revenues go out until 2052, and they're very predictable. There's some variations that, depending on what happens to inflation, they could be a little bit higher, a little bit lower, but they're very predictable. They tend to go in, they're not entirely smooth. There's periods of higher and lower depending on the cash flow cycles. But we have a tremendous amount of visibility compared to a typical business, and that's what allows us to make the statements like that we can pay a progressive dividend for the next 15 years. At the end of the concession, the asset reverts back to government. So there's very few of our assets have a renewal option, but a couple of them do. But more likely, it's that we continue to invest. And so when we went public in 2011, our average concession life is about 24 years. And now 12 years on, we're just on the other side of 20 at 19 and a change. So it has come down over 12 years, but it's been a slow decline, and we think we can continue to invest in new assets over time. But as I say, if we did nothing, we could pay a progressive dividend for the next 15 years. But certainly that's not our plan.
And just to be clear, this isn't like property, is it? It's not like there's a break at, there's a lease renegotiation after 5 years. When you sign a concession, that's unless you chose to sell that.
Yeah, I mean, one of the opportunities, I don't want to overstate it but one of the opportunities we're seeing is in some of our discussions, a lot of the governments we're working with have signed Paris-aligned net zero pledges, and they're thinking, how do we deliver on our net zero? So we are engaged in discussions with some of the clients saying, would you be interested if we almost a blend and extend, using real estate parlance, where if we were to upgrade the building, make it more energy efficient, et cetera, decarbonization, if we did that investment, would you consider extending for a period of time to allow us to recoup that capital? So we may see some extensions within the portfolio, but these are assets that eventually expire. But as I say, it's like running a bond portfolio. You have bonds that mature, and you take the proceeds and you buy bonds that are not mature, that have a long duration before they mature. So it's a similar approach.
Yeah, yeah. Do you want to just talk a little bit, switching lanes a little bit? Do you want to talk about how the discount rate moved across the rate cycle and how sensitive you are? Well, what are the key sensitivities that will change your NAV? This is, by the way, for viewers. This is in the report and accounts. This is always graphed out, isn't it? But it'd be
I'm
worth
going to
just
see if
talking
I
through.
think I have a, I'm going to see if I can find a slide. I don't know if people will be able to see this, but
Yeah,
I'll
we
put it
can
up
see that.
there.
Yeah.
Okay, great. So one of the questions we get is, you're effectively a bond proxy, and we would argue, hey, we have a lot of attributes like a bond, but we're not a bond proxy because a bond is very sensitive to changes in interest rate. So if you look at the first sensitivity there, what happens if you have a 100 basis point change in interest rates or discount rates rather? It obviously impacts the valuation of the portfolio. So it's quite a large number. But what we told our investors is that it's very rare, it's unheard of that you just get a change in discount rates in isolation. It usually happens in conjunction with higher inflation and higher interest rates. So because our portfolios all been financed, everything's been financed on a non-recourse basis, and 55 or 56 assets have no refinancing obligations. We're not subject to interest rate risk the way, say, a real estate portfolio would be, where you're having to. But what's interesting there is we, because of the inflation linkage, if you have higher interest rates, you might have higher discount rates, but you get the offsetting benefit that we have a lot of money on deposit at the various project accounts. So we benefit from higher interest rates. So that offsets it, and the inflation linkage offsets it. So the sensitivity that really is probably appropriate is what happens if you have 100 basis point change in inflation deposit rates and discount rates, and you can see that the sensitivity to the valuation is much more muted. So that's why our discount rate has changed quite a bit since interest rates started to move up. We went from 6.55 to 7.2 at mid-year. So we have adjusted, but it hasn't had a huge impact on valuation the way it might have had you, if you bought a long duration bond, would be more sensitive to changes in interest rates than our portfolio, because the offsetting benefits of inflation and the significant cash deposits.
Yeah. Yeah. Um, we I said a bit earlier we could come back and talk a little bit about bringing a couple of assets to life, and we've already touched somewhat on one of the questions, but worth rolling that into talking about a couple of assets. One of the viewers is asking about responsibility for maintenance of assets. So I guess if you pick a couple of examples and talk about but maybe talk about a bit more widely about the life cycle of when you pick them up. Because, so for example, you know, development risk or not, when do you enter the scene? How does a deal actually get structured? What's the ownership that the trust has?
So a typical deal, maybe we do some development where we take assets through construction with, where we'll be an investor and there'll be a construction company, but that's historically been a small part of our business. As I say, we had an asset that became operational in September, a roadway in Canada, but typically we're buying assets in the secondary market. So that's typically construction companies that invest in these projects, see them through construction, they're de-risked, once they become operational, they want to sell, recycle their capital and pursue another project. So we're typically buying a project that is in operation. It's been built by creditworthy contractors. So if there are problems, they come back. But there's rigorous review of these assets by lenders and technical advisors and governments and everything to make sure that they're built to the appropriate standards and then reach substantial completion. On most of our social assets, the buildings, we typically have a creditworthy counterparty that is doing the facilities and maintenance. And we have a variety, we're not exposed to one company. It's a variety across the portfolio. And they would do the day-to-day management, and they would do the life cycle. So if the walls need painting, if the boiler needs replacing, they would do that as part of their fee. On some of the roadways, it's a little different. We as an investor will take some of the life cycle risk, but roadways are a little more predictable in that it's different than say a hospital where if the lift breaks, you've got to fix it immediately. Roadways, you tend to have, you have to, we say black, green, and gray. You have to, or white, green, and gray. You have to. The white is plowing the snow in the winter. The green is cutting the grass in the summer, and the gray is dealing with the asphalt. So typically on a roadway, it has to be maintained and made available. And there might be an overlay or resurfacing after about 15 years, and then again at handback. But those are all factored into the budgets and accounted for, and there's reserve accounts and everything else, and that's why we have the significant cash reserves in our business. Is it's in anticipation of these life cycle events, and we earn interest on that. So, does that answer your question, Alan?
Yeah, very well. Yeah, good. Thanks. I think what we'll finish on, and I think everyone will understand if you have to be careful in what you say, is just on the discount and potential ways to address that.
Well, I think I won't claim to be the originator of this idea. It was some of our corporate brokers are Jefferies and Winterflood and Jefferies, but Jefferies has come out with a piece where they've said the seven henchmen of the large discount, and they give a series of reasons, but they're saying it's the paradigm shift, the end of the cheap money. It's a function of multi-asset fund shrinkage. So a lot of the multi-asset managers have seen their AUM decrease, and so that's resulted in selling. It's negative UK equity fund flows. It's the absence of the retail buyer in the UK to the same degree. There's been some in the investment trust space. There's been some reputational issues and governance issues. There's been Home REIT and Digital 9 and Neil Woodford, and and then more recently, it's the cost disclosure issue where there's been a lot of focus on some of the self-imposed penalties as a sector that we've sort of government has created for us, where we're shooting ourselves in the foot by making these products uncompetitive by just legislative requirements that are not really helping anyone. So I think it's the confluence of all those events, and I think at least from our perspective, our business has not changed. We're delivering critical infrastructure that society values. We're doing it well. We've got happy clients. We've got happy customers. We've got engaged employees. We've got an engaged team, and the assets are all performing well. The one aspect that is beyond our control is what happens in the market, and what we've been trying to do to address that is getting out and participating in events like this and telling the story why we think the shares are undervalued, And when we're trading at a large discount, as are many in the renewable and alternative space, we think that there's potentially, this is my personal opinion, not giving you financial advice, but I think the stock is undervalued, and I have a lot of my net worth tied up in this vehicle, as does our management team, as do our supervisory board, and we're in a closed period now, but I bought shares in the last open period in December, as did our CEO or CFO and many of our board members. So we're believers in the stock, and we're believers in the product. It's we're delivering critical infrastructure that society needs, and we're doing it well, and we're getting paid by creditworthy governments, and we've constructed a portfolio that I think is quite conservatively structured and robust. So yeah, I'm bullish on this stock at the current price, but I can't really give you much more than what what we're observing is the catalyst for this.
Of course, it's always good, so when you come to look at a discount, to have a list of good reasons why it exists, that because not all discounts are the same, and it's really helpful that you've listed quite a powerful set of external factors. The discount isn't a kind of reflection of your company; it's a reflection of wider factors. And I'm not going to tie myself down to any past performance being a guide to the future either by saying anything about mean reversion. But Duncan, really appreciate you answering some really good questions from the viewers, and thanks so much for your time. This presentation will be on our website in recorded form, and the slides will be available to download, and I think there's quite a bit of supplementary information at the back that we perhaps didn't have time to go over today. And as ever, Duncan and the team have several sleepless nights, I'm sure, in the preparation of their report and accounts, and I always recommend to anyone thinking of making an investment to go and read that excellent document. You can find it on Duncan's website. Duncan, thanks so much for your time.
And thanks very much for having me. And as I say, there's a lot of information in the pack that will be shared afterwards. There's a lot of information on our website. We release our results at the end of the month, and those are going to be broadcast for retail investors and for institutional investors, and that's all on our website. And if my email's on the website, if people have any questions for me or the management team, we'd love to hear from you. And thank you for your time today, Alan. I really appreciate it.
Excellent. Thanks, everybody.